Despite the attractiveness of gold in the current fiscal situation, gold is very, very, very under-owned. If precious metals merely returned to the 3-decade mean, demand for them would triple or quadruple.
Please join us for our next live stream Sunday, November 8th at 9 p.m. Eastern. We'll go over current events, past guests, and of course, gold and silver news. Once again, our next live stream will be Sunday, November 8th, 9 p.m. Eastern. See you then. Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira. As always, if you are new to this channel or you have not already done so, please do subscribe, hit the bell to be notified on new updates, and give us a thumbs up if you like what we do. We truly do appreciate your support. Rick Rule is our guest today. Rick Rule is the CEO and president of Sprott USA Holdings. He's also the founder of Sprott Global Resource Investments, and having survived 4 mining downturns and thrived in 4 mining upturns, Rick Rule is one of the best known and most influential people in the resource mining business. And we're delighted to have him here again as a return guest. It's time to saddle up and silver up for Rick Rule. Rick, welcome back to SBTV. How are you doing?
I'm doing very well, and it's a pleasure to be back with you. I enjoy our discussions, and I enjoy the opportunity to address your audience. Thank you for having me back.
Thank you for accepting. Likewise, I always enjoy the things you have to say. So does our audience, in fact. Rick, let's start by recalling the past. Your career has seen you witness 2 bull and bear markets in precious metals, one in the 70s and the other in the 80s, and in the last 2 decades. Obviously, these cycles, they do take years to play out. Looking back at what you've experienced in your career, would you say that the most needed virtue of a successful investor is patience?
Say patience and knowledge. I think the knowledge gives you the patience. And this is a very astute question. If you observe the prior bull markets, they surprise people both with their duration, they average 10 years, and their dimension. But within that decade-long bull market, there's lots of volatility. The silver market is an example. The silver price itself, not the price of the silver equities, but the silver price itself can fall by 10 or 15% with the ease with which you exhale. And having enough knowledge, having enough training, having enough discipline gives you the patience to understand the underlying strength of the bull market without being confused by the volatility. It's absolutely critical that investors understand why they're doing what they're doing, manage their emotions, and understand the underlying thesis well enough that they don't get shaken out by noise or attracted too much by upside volatility. Both kinds of volatility can create suboptimal investor behavior.
Can you share with us how you approach managing risks? When you buy or sell assets, for example, do you consciously try to avoid catching the absolute lows and the absolute highs?
I learned in my 20s that I'm not smart enough to catch the absolute lows and absolute buys. I try and take a great big fat slug out of the middle. There have been circumstances, I don't think I've ever caught the high. There have been circumstances where I actually absolutely caught the low. And while those are psychological victories, they haven't done anything to increase my net worth. What increases your net worth is avoiding catastrophic loss and having the courage to be early in a sector that rewards you extravagantly when you have no competition. Managing risk is a wonderful question. Risk is the study of risk. The academic study of risk is one of my avocations, actually. In addition to the conventional investing business, I enjoy understanding the insurance business, which is the backside of risk. So managing risk is actually a topic that I could discuss until I put all of your listeners to sleep. But managing risk is really an individual affair. The way that I might manage risk might not be appropriate for you at all. The first thing with regards to owning physical precious metals is, I would suggest that the greater risk is not owning any in the circumstance that we face. My own belief, for reasons that we discussed in our last interview, including the debasement of currency and the insufficient return on savings products, means that there are risks for the average person in not owning precious metals. It doesn't mean that precious metals, physical precious metals, aren't, it doesn't mean that they won't go up in price or that they will go up in price. It just means that to ensure your financial well-being, precious metals have performed well during periods of time where the efficacy of other savings products was called into question. So you need to look at the backside of risk. After that, you need to right size the way you take risks. I like to maintain a personal balance sheet that's very liquid. In other words, I like to have lots of cash and cash equivalents. I recognize that there is risk in that the interest rate which I receive on my fiat savings is negative relative to the depreciation of the currency. But I suffer that because having that cash gives me both the tool and the courage to take advantage of market downturns rather than being taken advantage of. I personally, too, consider my bullion to be cash, albeit good cash, volatile cash. And so, when you add my bullion holdings and my cash holdings together, you arrive at what's almost an embarrassingly large number. That's one of the ways that I manage risk. I have now been in my life through at least 4 liquidity squeezes in the broad equity market, where the broad equity markets fell between 30 and 50%. The last 3 of those, because I was prepared for them psychologically and financially, were very, very, very good events for me indeed. While 2008 was catastrophic for most investors, 2008, 2009 was a dream year for me as a consequence of being prepared. So that's one of the ways I manage risk. The second thing, and I'm sorry for this long-winded answer, but this is the best question I've been asked for a long time. The second part of managing risk comes from understanding the anatomy of a bull market, particularly in precious metals. Most people haven't been around or haven't paid attention well enough to understand the anatomy of a bull market, which is one of the reasons why I always refer to that Barron's Gold Mining Index chart. Many people have said to me, Rick, this market now is 18 to 20 months old. Gold is up by X, silver is up by Y. Have I missed the boat? If we were in a bull market, and I can make a persuasive argument that we are, prior bull markets, if you look at history, last 10 years, in the last bull market, the gold price, not the gold stock price, but the gold price was up 6-fold. So my suspicion is that if past is prologue, and if the fundamental reasons for this bull market stay intact, that this bull market has longer to go and further to go. Managing risk then tells you that you don't need to take inordinate amounts of risk to make money in this market. Simply owning the market beta, simply owning a representative sample of gold stocks, or if you have the courage, silver stocks, without taking the crazy penny dreadful risk, means that you will, if you are patient, make a lot of money relative to the money that you invested. In fact, there's an argument, and I've made it in interviews with you in the past, that for many investors who can't afford inordinate risk, rather than even owning an index, which might be 40 stocks, that you pick the best 5 or best 6 gold stocks in the world, highest margin, largest trading liquidity, and just own them. Be prepared to even underperform the index a little bit, but de-risk it entirely by owning the good ones. Now, most of your audience is young and aggressive, and so they're going to ignore this. And that's fine too. The way that you avoid risk and speculation, by the way, all of the money that this old man now invests so prudently, he made by speculating wildly. So don't confuse my whole message with my being. The way that you manage risk in speculation is 2 things. Right size it. Use an amount of money that you can lose half of without it changing your decision as to what to have for breakfast, because losing money is part of making money in speculation. But the second is more important. That's work. Own the number of stocks that corresponds with the number of hours per month that you spend working on your portfolio. And when I say working on your portfolio, that doesn't include YouTube videos. It means reading annual reports, reading property reports, reading quarterly reports, reading proxies, obtaining from the company condensed analyst report. Really understand your portfolio, understand why you own a stock, understand the value proposition, understand the unanswered question, and have a plan to sell. Know what will make you sell. What's your target on the stock? If something goes wrong, how will you know and how will you get off it? You manage risk by acquiring knowledge and using that knowledge to make a plan for your stock. We ask companies to submit business plans. Investors need to have business plans too, and they need to have a plan around every individual security.
Well said. Well said. I think a lot of people are gonna take that in. Rick, were the two previous bull markets in precious metals ignited due to investors' concerns of the loss of purchasing power of currencies?
Yes. In particular, the 1970 to 1981 bull market was, from my point of view, policy and fiscally related. For those of your audience who aren't as old as I and don't have a firsthand memory of it, the world's reserve currency then as now was the US dollar. But there was an understanding on a global basis that the US was abusing its privilege, that we were borrowing too much, we were running deficits. For those of you who don't remember, the United States fought a war in Vietnam, which it lost, and fought a war on poverty, which it lost. And the consequence of that guns and butter circumstance was that we fomented ourselves through our own policies a run on the US dollar. Gold had been price controlled at $35 an ounce. And when that price control came off, the pressures to own gold and exit US dollars were extraordinarily high. At the beginning of that bull market, which is to say 1970 to 1974, we had a stealth bull market. Gold went from $100 an ounce to $200 an ounce. And other than a few right-wing cranks, libertarians like Rick Rule and Harry Brown and stuff like that, most investors couldn't spell gold. And when it was interesting to watch, in the middle part of that decade, in 1975, they raised US interest rates. The US dollar strengthened, and the gold price collapsed from $200 an ounce to $100 an ounce. But everything else collapsed too. So the political class lost their nerve and went back to the fiscal policies of the 60s. And the gold price went from $100 an ounce to $850 an ounce. The lesson there, of course, is that midterm volatility can be extraordinary. But as long as the fundamentals are in shape, the bull market will be in shape. The circumstance in the year 2000 was not altogether different, although gold at first began to move as a consequence of recovery from an oversold bottom. The first part of the move in gold just had to do with the fact that it had sold off from $900 an ounce to $250 an ounce. But the same circumstance was in place. We had a series of interest rate cuts that really began in 1987 that culminated in very low real interest yields on savings products, including particularly the US 10-year Treasury. And the consequence of that, and the fact that gold was oversold, and that we began to have a multipolar world, meant that demand for gold outpaced, for a brief time, demand for US Treasuries. And that was the author of that bull market. Here we are again in 2020 with past being prologue for reasons that we can discuss if you'd like.
Okay, speaking of that 10-year US Treasury, do you see that US 10-year Treasury continue to be gold's main competitor in the next 10 years?
Yes. I think that the world's becoming more multipolar, not less multipolar. But I also think that the nervousness that other countries outside the US have for each other is greater than the nervousness that they have with regards to the US. As Doug Casey says, the US dollar may be terminal, but at present it's the prettiest mare in the slaughterhouse. And I think that the relative strength of the US economy, but also the depth, the liquidity, and the transparency of US capital markets means that US capital markets will preserve their leadership status for at least 10 years and probably longer. The US 10-year Treasury has been for 30 years the world's benchmark security. It's the one that other securities are priced against. I had occasion some years ago to talk to a manager of a very large Asian sovereign wealth fund about the US 10-year Treasury. And I described it in its negative yielding capacity as a sort of a lie. And I remember he looked at me, smiled, he says, "Yes, that's true. A deep and liquid lie." Now, just because he has to buy it doesn't mean that you and I have to buy it. A savings instrument that yields 70 basis points in a currency whose value is depreciating by 1.7% a year means that every year that you have your money in the US 10-year Treasury, you lose 1% of it. This is return-free risk. And to me, the strength in faith in the US 10-year Treasury has been the principal impediment to gold, and I see that faith being challenged. It's worth noting, too, and I think I've done this in prior interviews, but I don't know that the audience in this interview will be the same as in those. It's worth noting that despite the attractiveness of gold in the current fiscal situation, gold is very, very, very under-owned. In the United States, which is the market I know best, the market share of precious metals and precious metals-related investments is about 0.5% of all savings and investment products in the market. In other words, it's an afterthought. Gold doesn't have to defeat the US 10-year Treasury. It just has to lose less badly. In fact, the 3-decade mean market share of precious metals and precious metals assets among savings and investment products in the United States is between 1.5% and 2%. So if precious metals merely returned to the 3-decade mean, demand for them would triple or quadruple in the largest savings and investment market in the world. And that's precisely what I think is going to happen.
You said a interesting word there, under-owned. Gold is under-owned. Rick, I see the exponential ways governments have increased the money supply and debts. I mean, we see all these hockey stick patterns on charts, like the money supply, like the Federal Reserve balance sheet. With the situation already so dire and so much data is attesting to the seriousness of this money printing addiction, shouldn't people hold more precious metals in their portfolio for protection? I mean, a lot of people say 5 to 10%. What are they holding in the other 90%?
I'm not sure that most investors need to go above 10% because what you see in gold bull markets is that a little bit goes a long way. If you own gold as insurance, which I do, I try to make money in the gold stocks. I try to preserve my money in gold. If you own physical gold in a gold bull market, the potential price increase around that bullion that you own is so extraordinary that a little bit goes a long way. Now, how much you should hold really depends on your individual circumstance. There is no one-size-fits-all number. If a widow opens an account with me and she, as a consequence of raising a family and doing all those types of traditional things, doesn't have the life skills, the professional skills to make an income if she's reliant on her portfolio. And her portfolio consists of long bonds, traditional conservative investment. This woman will get killed in a set of circumstances like existed in the 1970s. And so this woman may need to own 20% in gold simply to hedge the purchasing power of her capital, which is denominated in instruments that will be murdered by the depreciation of the dollar. A younger person like yourself who owns a rapidly growing business, who can be a price maker as opposed to a price taker in the information business, might not need to own very much gold at all. It's the circumstances. What troubles me isn't a discussion as to whether somebody should own 5% or 10% or 15%. I think that's an individual issue. What bothers me is that the vast majority of people in the United States own none. In this circumstance, given the challenges around US dollar denominated savings products, I think that's very imprudent.
I agree with that. Uh, is there any other reasonable way working class savers can win this war from spenders other than protecting wealth in physical precious metals?
There's actually a better way. It's just hard. Invest in yourself. Invest in your education. Invest in the knowledge that will allow you to fill a market need better than your competitors. It's a truism that the way that you make money is by developing a product or service, or being part of a team that develops a product or service that services a market and delivers utility to other people. Building a business is still the greatest form of financial freedom. And you don't have to be an entrepreneur. You don't have to build your own business. You can be part of a business, but you need to be an integral part of that business. If you expect to make $500,000 a year, you have to expect to generate $2 million a year in utility to other people. So the best way in the world to secure your financial future is to secure a skill for yourself that enables you to deliver value for others. Traditionally, too, owner-operated real estate has been a wonderful way to secure financial future. But it isn't enough to just buy real estate. You have to improve the real estate. And you have to make sure that you have done a good enough job creating utility for your tenants, that you have some pricing power, that you can increase your rents by 2% or 3% or 5% a year, while your cost of capital, your mortgage, is fixed. The delta between your return on capital employed over time and your cost of capital is how you become wealthy. It takes time, which is why you have to start when you're young. But those are ways too. The simplest way, however, in my experience, in circumstances where it is much more likely than not that there will be disintermediation, a fancy word for selling conventional savings products because of artificially low yields, is gold and silver bullion.
Rick, you've highlighted on many occasions about the ever-increasing U.S. deficit, and investing in U.S. Treasuries is akin to lending lending to a borrower who is not going to repay. It's really the elephant in the room that no market seems to want to talk about or basically ignore. Do you think the market ignores this elephant in the room because no one has an answer about the mountain of debt that they just keep things going, hoping that the problem will resolve itself?
I think there are many reasons. The first is human nature. Ludwig von Mises, in Human Action, describes volition, which is to say willed self-interest. We regard ourselves as autonomous fact seekers, taking information from around the world and processing it rationally and come to rational conclusions, which is wrong. We actually absorb information that supports our existing thesis and paradigms, information that is convenient for us. And the information that we regard the most is recent information. So recency bias is important. We pay more attention to something that happened last month than we do to an analog that happened 10 years ago. We forget history, which is why I keep wanting people to look at these damn long-term charts. But the other thing is that we develop habits over time. With regards to bonds, we began a bond bull market in 1981. That market has gone from 1981 until now, a 39-year bull market. People get trained over a 39-year bull market. If something works and works and works and works and works and works and works with no effort and no risk, they want it to keep working. When people look at the political circumstance around the world, two things happen. The first is that we have gotten through crises in the past, and people want to believe that the big thinkers have the circumstance in hand. People, in fact, want other people to take control of their own financial future because they don't like the responsibility. They want to believe that Trump should kiss it and make it better, or that Biden should kiss it and make it better. And that's very unfortunate, I think. I think that people need to take control of their own financial future, irrespective of what they want. And the perniciousness of human volition. If you think about the fact that bonds have been in a 39-year bull market, that likely means, if for no other reason than exhaustion, that market is over. At the same time that we get trained to expect it, it runs its course. That bull market is evidenced by the yield on the 10-year Treasury. Of course, the capital value of the bond goes up as the yields decline. So the yield on the 10-year Treasury, I believe, peaked in 1981 or 1982 at 15.5 or 15.6. It's currently at 70 basis points. Could the yield go lower and the bond go higher? Yes. But are we at the end? Are we at the top of the range or at the bottom of the range? People need to look at that. They've been trained that bonds work, and so they're addicted to bonds as the attractiveness of the bond has evaporated. Sadly, that's human nature.
Yeah. You know, I've heard you mention about a bumper sticker that you saw in Enid, Oklahoma many years ago, and it said, "God, please give me one more bull market, and I promise not to waste this one." In that view, we now are in the early beginnings of a precious metals bull market. How can investors ensure they don't waste this bull market? Does it mean they should be buying instead of selling?
Oh, absolutely. From my point of view, absolutely. I'm not trying to say that you should be overweight precious metals too far, unless you are an adept speculator. But remember that most of society doesn't own any precious metals at all. And to win the lottery, you got to buy a ticket. So you got to get on board. In the first instance, you have to get on board gold, not to make money, but to preserve the purchasing power that you have. A little bit goes a long way. If you decide you want to make some money, not just preserve your money, you probably ought to speculate and buy some silver bullion too. I know that makes you happy to hear that, but I believe it to be true. If you study prior bull markets, gold moves first, but when silver moves, it moves further and faster. It's more speculative than gold, to be sure. If you can afford the risk, buy the gold equities. Begin by buying the best. Remember that the index itself in a bull market can move 500%, 600%, 700%. So begin your equities portfolio owning the best of the best gold stocks, or if you're speculative, add some of the best silver stocks. Then, after you've done those two things, speculate. And if you speculate, work. But there are very few circumstances that I'm aware of that have the equivalent secular opportunity of a precious metals bull market. And I believe, like you, that we are not in precious metals merely in a cyclical recovery from an oversold bottom, which I believe that we were in 2018, 2019. I think we're in a genuine bull market. And I think a study of past bull markets is warranted. Let's go, if you'll indulge me, to the case for this bull market, because I think it's important to understand and either believe or not believe the reasons why we're in this bull market. If you understand the reasons, you'll pay less attention to price and you'll understand more about the dynamics. Traditionally, precious metals investments have done well, as we said before, when there's fear of the efficacy of the purchasing power of underlying currencies and savings instruments. And I'm going to focus on the US dollar and US instruments, both because I live here and also because they're the world standard, whether we like it or not. The first challenge to this faith in the US dollar is quantitative easing. That's a fancy word for counterfeiting. It's the fact that the government does it that makes it legal. If you did it, you'd be in prison. If they do it as policy and it gets you reelected. But there can be no doubt arithmetically that keystroking up new currency units without any expansion in the underlying economy is debasing the currency. That's what it's doing. The second is debt. and deficits, a different form of debasing the currency. That's particularly pernicious. And the amount of debt that we have in place is staggering. In the United States, the on-balance sheet liabilities of our government are $27 trillion. And the Congressional Budget Office estimate of the off-balance sheet liabilities exceed $150 trillion. So we have $170 or $180 trillion net present value in obligations. We service this debt with the national income, which is to say taxes and fees, less expenses. The problem with that is that that number is negative this year to the extent of $3 trillion. In other words, rather than servicing the debt, we add to it. If this doesn't demean faith in the efficacy of US dollar denominated savings products, I don't know what would. The crowning glory, of course, is negative interest rates. Interest is the compensation that savers get for postponing production, or pardon me, consumption. And it also implies a time value of money premium and a risk premium. And increasingly, even when your debtor is the US government, when you look at the balance sheet of the US government, $170 trillion upside down, and adding to that $3 trillion a year, you require a risk premium to lend that debtor money. And rather than that, you pay a penalty. The disconnect between the interest rate that should be charged a debtor in that condition and the interest rate received is the strongest impetus that gold has. So when one makes an investment in precious metals and precious metals equities, one needs to have a framework in place to understand when to call off the trade. In other words, when a trend is in motion, it's in motion till it's over. How can you tell it's going to be over? It's important. That's pretty easy. When quantitative easing stops, when the deficit in the United States is less than 1% of GDP, in other words, when we begin to have the ability to grow our way at least into debt service, and when the interest rate on the US 10-year Treasury goes at least 200 basis points positive. Now, if the Congressional Budget Office estimate of the decline in purchasing power, which, by the way, I believe is unrealistically low, but let's give them that, okay? If that's 170 basis points, if the interest rate of the US 10-year Treasury was 3.7 before, and the decline in purchasing power was 1.7, then gold would have some really, really, really stout competition. And then remember, too, that gold is underowned. If gold's market share, when I say gold, I mean precious metals market share, approached or exceeded historic norms, which is to say 2% or 3%, then you could begin to say that gold isn't underowned, that you don't own an asset class that people aren't going to flood into after you. So I think if you think of the bull market in the context of those factors, market share, negative interest rate, debt and deficits, and quantitative easing, you will understand, first of all, the impetus and the dynamic of the market. And you will also have quantitative factors in place that will begin to tell you when to question your premise and when to sell.
Rick, are you expecting this gold bull market to top out anytime soon, or are we looking at 3 to 5 years or more?
I can't tell you in terms of duration, other than saying previous bull markets have lasted 10 or 11 years. I think it's much more important that investors who concern themselves with that question look at the premise as to why the bull market was caused, and look at the quantitative measures that I gave you earlier. If investors pay attention to real interest rates, if they pay attention to the market share of precious metals related assets relative to other savings and investment assets, if they pay attention to debt and deficits, and if they pay attention to quantitative easing, that is, if they pay attention to the factors which would cause the dollar to rally relative to gold, they will more or less be able to answer their own question. For many investors, they won't be able to do that. If the gold price were to go from its current level to some number like $6,000 or $7,000, by the way, something that I don't think is unlikely, for most investors, Whence gold has made the move that it needs to make relative to other asset classes. In other words, when gold doesn't need to go up anymore, investors will be attracted to it because the price move will justify the narrative. People won't believe the narrative until it's been demonstrated by price action. That's why bull markets always extend past their rational norms, and bear markets always extend past their rational norms. So paying attention to a market per se, or the pricing levels per se, almost guarantees failure. Because you will let the price of an object determine for you its value. And it's an artificial construct. You need to understand the reasons for the move and understand when the reasons cease, because the reasons for the move will cease before the market turns. And you need to get out at some point in time to crystallize the gains that you've made. If you look at that Barron's gold chart, what you will see is that the backside of a bull market is just as steep as the front side, and it's a lot less fun.
Rick, when you rank resource stocks for clients from 1 to 10, why have you given out less than a dozen 1 rankings in some 3 decades? And what characteristics would a stock warrant a 1 from you?
1 means back up the truck. It means exhibit no caution. Specifically, I need to believe, in order for something to be a 1, that they have a world-class tier 1 asset. In gold equivalent basis, that means 5 million ounces or more in situ reserves and resources, with the capability of producing more than 400,000 ounces a year. The company has to have good or great leadership that I have prior experience with, so I know them and trust them. The stock has to be selling for less than half of what I believe it could be liquidated for today. In other words, I have to believe that it's selling at a discount to intrinsic value. And I have to believe that a catalyst is in place that will see the stock double in 18 months or less. In addition, there has to be visibility for this catalyst. I have to understand it. And in addition, the stock has to have the possibility, not the probability, the possibility to increase tenfold in price within the 5-year time frame. That range of attributes, the fact that it has to have every single one of these. Oh, and by the way, there has to be strong inside ownership. That range of attributes means that I'm able to award a 1 very infrequently. The last one is illustrative. The last one occurred, if my memory serves me well, in 2016. Ivanhoe Mines, run by my friend Robert Friedland, was selling at 63 cents a share, and it had 95 cents a share cash in it. In other words, the market capitalization was substantially less than the cash in the Treasury. But the company had 3 world-class assets. The Platte Reef in South Africa, Kamoa in Congo, and Kapushi in Congo. And my sense was that the assets in the company could be liquidated to willing buyers at $2 a share. So I thought that the liquidation value of the company was about $3 a share. And it was selling for 63 cents a share. The catalyst was the fact that Zijin Mining paid, if my memory serves me correctly, $1.17 for the stock that fell to 63 cents. Zijin Mining is a parastatal backed by the state of China. And right before that, the government of Japan, or at least the parastatal arm JOCMEC, had paid $200 million for a 10% interest in Platte Reef, which arguably valued Ivanhoe's share at $1.8 billion. It was a silly conjunction of opportunity. Now, a speculator needed to get past investing in South Africa, which is risky, and investing in Congo, which is very risky. But the circumstances and the fact that our joint venture partners were the government of China and the government of Japan made me believe that the political risks were, while still present, acceptable. That's the architecture of a one. They're very, very rare.
Okay. Rick Rule, before we wrap up, can you let our viewers know more about Sprott Global and how they can benefit from its services?
I can, as a matter of fact, and thank you for the opportunity. What we do as part of our outreach is we try to benefit you, the listener and the reader, directly. To that end, we have a web link, sprottusa.com/rankings. If you go to that web link, you'll find a web form. And if you enter on that web form the name and symbol of all of your resource portfolio, natural resource portfolio. By the way, please no banks, please no tech companies, please no cannabis companies. Only resource companies that we might understand. We will rank those companies 1 to 10. When I say we, I will rank those companies 1 to 10. And I will comment on individual issues where I think my comments might be of value. Understand this isn't investment advice. I'm not ranking the efficacy of these companies for your portfolio, but rather I'm merely ranking the companies. In addition, as an illustrative tool, I will send your viewers who request it the 50-year Barron's Gold Mining Index chart, not because of technical analysis, but rather because it's the best visual illustration of bull markets, how they act, and the best form of macro awareness that I can send in terms of understanding how to trade a bull market. And I will also send a 100-year commodity chart because I believe 3 years or 4 years or 5 years from now, there's going to be a very strong bull market in other commodities. And I think it's important to understand how commodities markets act relative to other parts of the economy too. So I will rank your portfolio. I'll comment on some companies in your portfolio. I'll send you the Barron's Gold Mining Index chart, and I'll send you a 100-year commodity chart. Please be patient. This is a fairly popular offering, and I know that Silver Bullion TV has a very, very, very broad audience. So I suspect that I'll get a lot of responses. It'll take me a while to work through them because I do them all myself and I do them all individually. And in addition to that, the rankings database has 1,300 companies, which we update fairly frequently. So this is a long labor of love. If you don't get a response back for a week, please be patient.
Okay, Rick Rule, we appreciate that offer. We'll be definitely sure to pass it on to the viewers, and I know they'll take you up on it. But we appreciate the time you've given us, and I hope we can do this again soon.
Thank you for the opportunity.
That was Rick Rule, President and CEO of Sprott USA Holdings, sharing with us his invaluable insights and the opportunities in the gold and resource industry. To find out more about Sprott Global, please visit the website sprottusa.com. If you like this video, please hit the like button and subscribe to the SBTV channel to be updated on new content. And do also check out the SBTV podcast on iTunes and Spotify.